Hello and good morning. For those of you that we haven't met yet, my name is Kate McKenzie. I am the Director of Development at the Pittsburgh Foundation. Welcome to our Spring Continuing Education webinar. We're so glad you're here. I am joined by a couple of my colleagues in Development and Donor Services. Amy Razum is here, and also Mallory Reese. Mallory is with the Community Foundation of Westmoreland County and Development and Donor Services, which is an affiliate foundation of the Pittsburgh Foundation. We're glad to see you here today. There's going to be someone on this call who's very important to us and has been for years, John Harmon. He's been a longtime board member of the Pittsburgh Foundation and also the chair of our Development and Donor Services Committee. He just stepped off, so we're glad to see you here. I want to take time right now to thank our sponsors for this event. We couldn't do it without you. We want to thank the Estate Planning Council of Pittsburgh, so Ann McKenna and Betsy and everyone there, and also for FNB Wealth Management support, financial support of this webinar. We really appreciate it. We have a great program for you today. Sam Donaldson is here. I know you all know who he is. And before we start, I just want to say the last 14 months has been a complete wild ride, and we want to say how much we appreciate your help and support at the foundation. So you're navigating now re-entry to the office, possibly connecting with people or reconnecting with people in different ways because of the vaccination being rolled out. And everything that you've done to work with your clients and work with us is so much appreciated, whether that's been to help them create a donor advised fund to give back to basic needs of individuals in our region who need the help so much, or to partner with us on our racial justice work in the Pittsburgh area. So thank you, you're making a difference in our community. Before we start today, I just have a few housekeeping notes that I'm gonna run through. I know you're all very used to this. We're recording this presentation today and we will send you a follow-up. The slides will also be sent to you after the presentation. Regarding your continuing education credits, so your CLE, your CFP, your CPE, and your CFTA, we have everything for you here, cornucopia of letters. We will post the link to a survey at the end of the presentation in the chat box. So there's going to be a link to a Survey Monkey, and we will also have a code there. You will have to submit your responses to that survey in order to get your credits. So we can report them and you'll be all good to go for your respective designations. You'll also notice that there are going to be polling questions pop up during the presentation. Please make sure that you're participating in those. That's really important for us to make sure that we are fulfilling our requirements for the continuing education credits that you'll be getting. And Mr. Donaldson is amazing and you will have no problem for an hour of just fantastic programming with him. Also, the chat feature's open. So he will be answering questions at the end of our presentation today. So feel free to write those questions whenever you'd like. Just know that we are going to save those till the end of the presentation. Your cameras have been turned off so you can see us, but we can't see you. So no pressure there, and make sure that you stay muted during the presentation. That would be very helpful for everyone on the call. As you know, today's speaker is an estate planning expert and Georgia State University professor, Sam Donaldson. He's going to give you such great information today, but to fully introduce our speaker, I'd like to introduce Kevin Day. Kevin is Vice President and Wealth Advisor with FNB Wealth Management, and he's going to say a few words and introduce our speaker. Kevin?
Thanks, Kate. Good morning, everybody. My name is Kevin Day. I'm a Vice President and Wealth Advisor with FNB Wealth Management within the greater Pittsburgh region. We're thrilled again to once again partner with the Pittsburgh Foundation for their continuing education events and just to support such a great organization that's doing fantastic things within the Pittsburgh region. We're hopeful we're going to be able to hopefully, knock on wood, see everybody soon in person. Before I introduce our speaker, just wanted to spend one quick minute to give everybody an update on FNB and FNB Wealth Management. For those who don't know, FNB Wealth Management is an affiliate of FNB Corporation, locally known as First National Bank. And our organization has actually grown quite substantially over the last 5 years, becoming one of the larger wealth management firms in Pittsburgh with over $6 billion in assets under management. So as you can see on the slide, FNB Wealth Management serves our clients through a variety of business lines with significant experience in managing complex trust relationships, teams dedicated to implementing investment and financial planning strategies for individuals, as well as significant experience working with institutions, whether that be an endowment or foundation, or a company retirement plan or pension through FNB's Retirement Services Division. That experience also extends to banking with regards to lending or deposit needs. So I would encourage anybody in this audience to reach out to us directly if you're interested in partnering or learning about any of the ways we might be able to assist you or any of your clients through our full service teams at FNB and FNB Wealth Management. Our speaker today, as you heard, is Professor Sam Donaldson, who's a professor of law at Georgia State University in Atlanta and has served as the director of the law school's graduate program in taxation. He teaches a number of tax and estate planning courses and is an academic fellow of the American College of Trust and Estate Counsel, as well as being a published author. Among his publications are Federal Income Tax, a Contemporary Approach, as well as The Price of Contemporary Estate Planning. Now, I've been assured that Professor Donaldson is as close to a celebrity as you're going to get within the tax and estate planning industry. So I know I speak for everybody on my team here at FNB Wealth Management when I say we're very excited to hear what he has to share with us today on what should be a very timely topic. So without further ado, I'll turn the Zoom call over to Professor Donaldson. Thank you.
Thanks very much, Kevin. Way to oversell it with being an estate planning celebrity of the like. I think only because I share the name with the former ABC News broadcaster that there's any kind of coattails to ride that way celebrity-wise. But I very much appreciate the introduction, and thanks everybody for coming out today. I so wish that I had the opportunity to be able to visit one of my favorite cities in person, but I guess we'll just do one more Zoom call and hopefully we'll have the opportunity to get together as a group again in the coming years. Want to be able to make the most of the hour time that we have together, and it seems now that we are transitioning back into life that's relatively normal. We still are seeing an awful lot of upheaval and uncertainty on the estate planning front. And I know that on a lot of the different listservs of which I'm a member, it seems as though people are talking about a lot of strategies to take advantage of where we are now. This idea that we're in a very unique time in our professional careers as estate planners with the types of strategies that maybe now more than ever might make a little bit more sense. It just seemed to me it might be valuable for us to spend some time reflecting on what is it that everybody's talking about when they're talking about, ooh, we should be doing this strategy or that strategy, or what are some of the things that people are putting into the minds of our clients that they're then turning around and contacting us to want to know how to plan with. So that was the genesis then for this topic of, well, what the cool kids are doing in estate planning. It's perhaps with great envy that I talk about with what cool people are doing, but what are they talking about over there at that side of the cafeteria in which I'm not welcome? Well, before we get into some of the particulars, let's set a little bit of context because, I mean, there's the great Chinese curse that says, may you live in interesting times. And I think if there's one thing that can describe the last 14, 15 months in our profession, it's been interesting. With all that has been going on and where we find ourselves right now. I mean, yes, we're hopefully getting toward the tail end of the pandemic. We're starting now to see asset values are starting to recover. Our clients who had closely held businesses are starting to be able to operate them at full speed again, which is not to say that things have necessarily fully rebounded. We might have clients that are still looking at portfolios that haven't fully gotten to their pre-pandemic levels yet. But given the optimism that we have about how they might be soon returning, maybe we need to take advantage of the fact that assets are temporarily deflated in value. Keep in mind too that, I mean, it seems like for the last 10 years, we've been talking about historically low interest rates. And certainly while we were in the pandemic, interest rates practically bottomed out. Hell, banks were practically paying us to borrow money from them, right? We are still seeing very low interest rates, and it's still a very favorable environment for strategies that take advantage of low interest rates. But they are starting to creep back up ever so slowly, suggesting that if we really want to get full advantage of some particular techniques, our clients really need to paint or get off the ladder. which was not the metaphor that I learned as a child for that term, but it's the only one that I can share with you all in a recorded conference call, right? Combine that with the fact that a lot of our clients might still have some ongoing health issues, or certainly the high increase in mortality that we've seen over the last year has prompted a lot of our clients to get their affairs in order without having to necessarily consider how the laws might be changing. But then two, fold on to the fact that we've already seen one piece of tax legislation come through in a Biden administration with a democratically controlled Congress. All eyes are now looking at November and December, because when the next fiscal year reconciliation bill process opens up, that means that, assuming we're not looking at any kind of bipartisan tax reform package between now and then, it's very likely going to be November or December when we would expect to see some new form of tax legislation. And everybody's talking about how, given how we've spent trillions of dollars literally in COVID relief, we need to start paying for that. We've already looked at an announcement of, well, let's do something about our infrastructure. And as we start to tackle other priorities in a Democratic congressional agenda, we're going to need revenue to pay for it. So everybody's expecting that we're going to see probably an increase in tax rates. Where exactly those would be cut, how that exactly would work, we don't, of course, know the details, but we're expecting that there's a tax increase that could be coming down the pipeline. Couple that with the fact of, well, if you are needing to raise revenues, perhaps you could be looking at reducing exclusions for the federal gift, estate, and generation skipping transfer taxes. And so while we currently live in an environment where every one of our clients has an $11.7 million exclusion, $23.4 million per married couple, it's conceivable that we could see an earlier than expected reduction in that exclusion amount, such that a significant portion of your client base could go back to being rich and thus having transfer tax concerns. And so some clients might be thinking, do I need to hurry up and use this $11.7 million exclusion before it drops to 5 million, to 3.5 million, to 1 million, who knows what, who knows when. So with all that's going on in the world, I think that kind of gives us a pretty meaty agenda, or for vegans in the room, a soy-filled agenda to occupy our time here for the hour. We'll talk about what are some strategies that people are looking at if they find themselves in a lower bracket than expected, or perhaps if they still have an asset portfolio that has yet to fully rebound, and how we can take advantage of that. How, if you are exploring making a significant wealth transfer this year before exclusion amounts go down, what are some of the smarter ways to do that? We should talk about how people are still creating the so-called non-grantor trust to be able to defer, if not outright avoid, the imposition of state income tax, and how that can be uniquely available to Pennsylvanians thanks to your favorable state court precedent. We should talk a little bit about how people are stumbling to the use of charitable trusts as sort of the new IRA or retirement plan beneficiary in light of the Secure Act, with some of the benefits that that can provide. Talk about techniques for maximizing the step up in basis that's available on the death of a client. Moving away from the use of short-term GRATs that we've all become very accustomed to over the past several years, into considering even doing the ultra long-term GRAT, or sometimes called the 99-year GRAT, where we know the client isn't going to survive, but we're trying to take advantage of the fact that we think interest rates at death will be higher than they are now. And then, of course, it seems like a lot of people have been talking about the use of so-called spousal lifetime access trust, or SLATs. We have GRATs and we have GRUTs, we have CRATs and we have CRUTs, we have CLATs and we have CRUTs. We love our acronyms, right? We have SLATs. Nobody came up with spousal lifetime unit trusts, probably because the acronym there isn't nearly as palatable as it might be in other contexts. But spousal lifetime access trusts have become a very popular thing. We should make sure that we understand how they're working and how best to fine tune them for use for our clients. Well, let's start with this little making lemonade out of lemons thing. If we find clients are in a lower bracket for 2021 than where they expect to be in 2022, either because their business activities have still been relatively slow to recover, and they're thinking it's really not going to be until the next taxable year before things are fully back to normal, or because they anticipate that because of legislation, they're going to find themselves in a higher bracket next year than they will be this year. What are some things that you should have in mind to take advantage of the fact that this could be your last year in a relatively lower bracket? Well, certainly harvesting your capital gains while there's still a preferential rate on capital gains makes sense. You all know that there have been winds about proposed legislation that might repeal the capital gains preference for certain high income taxpayers above a certain threshold. And while I tend to be pretty skeptical about the chances of that legislation actually seeing the light of day and becoming a part of any legislation that's enacted, it's reasonable to expect that we might see some increase, maybe not as drastic as proposed legislation would indicate, but some increase in capital gains rates. And so maybe it makes some sense to go ahead and recognize some gains this year when the maximum rate, by the time you fold in the 3.8% net investment income surcharge, is only 23.8%, as opposed to some higher percentage that you might forecast later in the year. Certainly, if we get an idea of what proposed legislation is going to look like in the fourth quarter of this year, you'll want to have clients with their finger on the mouse, ready to click and execute a trade before it looks like higher rates might go into effect. This could also be the last year for a while that a Roth conversion might make sense, because while conversion from traditional to Roth is a taxable event, and thus the reason why many people haven't converted, when you run the numbers, if you have a client who's going to start pulling distributions out of an IRA in the next 3 to 5, maybe even out to 7 years, having it be taxable now while the client's in a lower bracket, if it means that subsequent distributions from that new Roth IRA in years in which tax rates are higher will not be subject to tax, you might come out ahead, even though you're paying the tax sooner rather than later. It's a very number crunching dependent, very much a client call, depending upon what the client thinks is the realistic horizons and what tax rates might look like and the impact of a present value of a tax hit today versus deferring it over into tomorrow. But when you run some of the numbers, in a lot of cases, a Roth conversion can be a pretty sensible move to do this year while the rates are relatively low. And then, of course, there's this thinking of, well, I need to hurry up and take advantage of my $11.7 million exclusion before I wake up. And like the McRib, it was available for a limited time only. And I come to find out it's not at my menu when I want to go and use it. Have no fear. They always bring the McRib back every October, and it stays on the menu through the end of January. And I'm really sad that I know that. This actually, speaking of the potential for a reduced exclusion, Taryn, I think this might be a good point for us to throw up our first polling question that we have to do for continuing education purposes, and just to kind of get a sense of the room of what you might think will happen to the federal wealth transfer tax exclusion amount. So you're seeing up on here on your screen now a poll question about what you think will happen to that federal wealth transfer tax exclusion amount. You can click that you think it will drop before the end of the year. If you think it will stay the same this year, but will drop effective as of next year. If you think it won't be dropping anytime soon, but maybe sometime before its scheduled reduction in 2026. If you think it will drop as scheduled, because remember, current legislation says it will drop back down to 5 million adjusted for inflation come 2026. Or if you think it's not even going to drop then, because exclusion amounts don't tend to go down. We'll give you a few more seconds to be able to chime in your vote. This is a way to prove that you were not out mowing the lawn on this beautiful day while we were all in here talking about tax law. Pity on you. You're sneezing and you don't get the benefit of getting to hear about tax too. It looks like a lot of folks have still chimed in. We won't quite end the polling so that we can give those last few people who are having just the devil of a time trying to decide between these options which one to pick. I wish I could tell you that there's a correct answer on here and that I could tell you which of them is going to be correct. So I'll be interested to see what the vibe of the room is about what it is that we're expecting. All right, this is like microwave popcorn. You don't want to wait for every kernel to pop because then it's just going to go bad. Good, somebody decided to go ahead and pull the popcorn out. So we're taking a look at the results. Look at that, fully half the room is thinking that it's going to be lower next year. So you've got this calendar year to take advantage of it before we reasonably suspect that it's going to go down. And then, we have, all but an optimistic handful that are saying it's going to be going down and perhaps here sometime soon. I like the really optimistic people that are saying it's never going to go down. And I get where you're coming from, because only once in our history has the exclusion amount gone down. That was 2011, when it went from infinity in 2010 down to $5 million, although at the time that just seemed so ridiculously high. So if the vibe of the room is correct, and I suspect there's good reason to feel like it is, then maybe we should talk about how to take advantage of this exclusion while it's still available. So if gifting is going to be the way that you're looking to utilize that exclusion, I think there are a couple of techniques that look especially attractive right now in this low interest rate environment. The installment sale to the defective grantor trust, I'm not entirely sure has ever been better really in our professional careers. This is the idea, of course, where the client takes the appreciated asset and instead of making a taxable gift of that asset into an irrevocable trust, creates the irrevocable trust that instead buys the asset from the client. As long as that trust is structured as a grantor trust for income tax purposes, that is not a gain recognition event because you are selling to yourself. And Revenue Ruling 8513 says, look, transacting with yourself is perfectly normal, perfectly healthy, as they taught you in high school health. We all do it. We just don't need you reporting it on an income tax return. So I can sell property to a defective trust. It's not a gain recognition event. Because I'm selling it, it's not a gift. And because what I'm taking back in exchange from the trust is a promissory note with a fixed face value that's paying me applicable federal rate interest in the meantime, I have effectively frozen the amount that could be potentially subject to estate tax. And if I have a client who's not currently subject to estate tax, but in an era of a reduced exclusion could be, this idea of freezing the amount that would be included to its current value of the property, as opposed to its date of death value some 5, 10, 15, 20 years out, is a very attractive proposition. Given the very low interest rates that are in play right now, you're not forcing the trust to have to commit too much in terms of paying amounts back out to the grantor over the life of the note. So it becomes a very tax efficient way to make a leveraged wealth transfer into that irrevocable trust, getting all that subsequent appreciation out of the estate. And then another one that I think works really well is the charitable lead trust. I mean, you go to most of these seminars and they're going to talk to you about remainder trusts for 8 of the 9 hours that you're there. And they're only going to spend a little bit of time on lead trust because up until recently, there wasn't a lot to be said for lead trust. But now the lead trust makes a lot of sense. Because remember, when you set up a lead trust, the charity is going to be the one that receives either the annuity or the unit trust interest for up to 20 years, followed then by the remainder going to the non-charitable beneficiary. Well, when I set up a CLAT, I am making a taxable gift of that remainder interest, but I'm making a gift of the present value of that remainder interest. And for purposes of computing the present value of that remainder interest, the Section 7520 annuity tables are assuming that this trust throughout its 20-year life is only going to grow at the 7520 rate in effect at the time when the trust is created. If I create a trust today, when the 7520 rate is 1.0%, all of the computations for my taxable gift are going to assume that that trust is only growing at 1% between now and the end of this trust, when you and I know that I can almost get a checking account to grow at 1% interest. If I have a halfway competent trustee, I can get a return on that that's much better. And so even though I might be paying a generous annuity amount to the charity consistent with my philanthropic agenda, while the tax return is saying I'm making a very modest gift because that charitable annuity is eating into the growth of the trust and there's in fact very little left for the non-charitable beneficiary at the back end, oftentimes there will be a pretty substantial amount going to those non-charitable beneficiaries and making a gift at literally pennies on the dollar. Run the numbers on your CLAT and on your CLET calculators. You won't believe how ridiculously small those gifts can be in this current low interest rate environment. But you know, this thing was even better last month when the 7520 rate was 0.8%. And it's better this month than next month because next month we know the 7520 rate is 1.2%. Every time that 75/20 rate goes up, the clap becomes a little bit less attractive. So this might be not a strategy to wait around until November or December. This might be a strategy of, we want to do this in April or May while that rate is still ridiculously low. So no matter whether you're doing the installment sale transaction, no matter whether you're doing a CLAT, even if you're just doing a, I'm going to make a ginormous gift because I want to take advantage of the exclusion before it goes down, I think there are some things that you want to think through as you are making those large wealth transfers intended to utilize the exclusion. Think through what it might mean to add some disclaimer provisions inside of this so that I can go ahead and make a gift today. But if it turns out that the exclusion amount doesn't go down, if I have a cooperative trustee, perhaps as the beneficiary of the gift, maybe the cooperative trustee can disclaim the gift and the property can come back over to the grantor. A lot of your clients are like, well, yeah, if the exclusion amount is going down, I want to make a gift. They don't want to make a gift, though, if it turns out that the exclusion amount doesn't go down. If the only thing prompting them in making a gift is that the exclusion is going to go down, having some good language in your gifting instrument about what happens in the event of a disclaimer can preserve a little bit of flexibility. Of course, one of the other things that I'm a big fan of now, I have to confess, when it first came out, this idea of trust protectors really kind of spooked me. That there was this person who was not a trustee, not a fiduciary, but they just kind of sat over there on the bench waiting until there was some smart time for them to swoop in and either take away some power or confer some other power to my grantor or to a trustee or to a beneficiary so as to achieve some kind of after the fact savings. Always struck me as a little bit hinky, but it turns out it seems to work. So if that's the case, why not build in a provision that would say, okay, if I'm going to make an $11 million gift into a trust, I want that trust to have a trust protector. And I want that trust protector to be able to have the power to give the grantor a general power of appointment, whether one that is exercisable during life or at death. Because here's what I'm thinking. It's great to make a leveraged gift of $11 million into an irrevocable trust if it turns out the exclusion amount goes down and you're wanting to save on transfer tax. The problem with transferring $11 million into an irrevocable trust, though, is that the assets that I transfer into that trust are not going to get a step up in basis for income tax purposes when the decedent dies, unless I can design that trust in such a way where if it turns out the exclusion amount never did go down, or the exclusion amount stayed where it was, and as a result, transfer tax never really became all that big of a risk, I don't want to regret the fact that I lost that opportunity for a step up in basis. So if I can give a trust protector a power to give my client a general power of appointment, my client dies holding a general power of appointment, yes, all of the trust assets will be included in my client's gross estate. But importantly, under section 1014B9, any assets that are included in a decedent's gross estate get a step up in basis. So that's my way to preserve the opportunity to get a step up in basis for assets in an irrevocable trust when it turns out I didn't need to save on estate tax after all. So I like this idea of a trust protector sitting on the sidelines waiting for the grantor to, if I can use medical terminology here, circle the drain, and then look at things and say, oh, it doesn't look like there's going to be the payment of transfer tax. Why not give the client this general power of appointment? It's going to cause gross estate inclusion, but they're not going to pay estate tax anyway. But that gross estate inclusion is the key to getting a step up in basis. It can be a very smart, very flexible strategy. And then lastly, I have this reference on here, of course, of nobody should be making gifts of property. You should always be making gifts of value. I mean, if I'm making a gift of cash, or if I'm making a gift of marketable securities, okay, I can go ahead and make a gift of that property itself. But if I'm making a gift of anything that needs an appraisal, fractional interest in real estate, artwork, closely held stock, partnership or LLC interests, if I'm making a gift of any of those other things, I am not giving the underlying asset. I'm giving a certain dollar's worth of that asset, right? Didn't we learn a decade ago in the Wandry case that the right way to make a gift of, say, limited partner interests in a family limited partnership is not to give a 15% limited partner interest. What you do is you say, I'm going to give $11 million worth of limited partner interests. Then I'll go out there and I'll get my appraisal. The appraisal say, okay, $11 million translates to a 30% interest. I'll transfer a 30% interest. If the IRS challenges the appraisal and says that appraiser was way too aggressive on the marketability and minority interest discounts, we think that that 30% interest was in fact worth, say, 15 million or 20 million, and therefore you owe gift tax. We'd say, no, no, no. The document says I'm only transferring $11 million worth. If the IRS tells us that in fact the appraisal got it wrong, thank you, IRS, for policing it. We'll make the adjustment. Turns out, well, I guess that means we only transferred a 20% interest or a 25% interest or whatever $11 million translates to. But I didn't make a taxable gift because I only gave $11 million worth. The service hates that. The service thinks that that violates public policy. But the Wandry case in the tax court said, yeah, but it works. And remember, the IRS, while it did not acquiesce in the decision of Wandry, nonetheless let go of its appeal that it had pursued. Now, last summer, there was a case in the tax court where there was a taxpayer that attempted to use a formula clause, but they didn't quite do it right. In the Nelson case decided last summer in the tax court, you had a married couple that did a gift to a defective grantor trust at the end of 2008, followed by a sale of property in the beginning of 2009. And here was the language from their instruments. The gift document said, I'm going to give a limited partner interest having a fair market value of $2,096,000 as of December 31, 2008, as determined by a qualified appraisal within 90 days of this agreement, followed just a couple of days later by a sale document in which there was a sale of a $20 million limited partner interest as determined by a qualified appraisal within 180 days of this assignment. Well, notice the gift is only 2 days before the sale takes place. The idea, of course, being that, well, we can just get one appraisal because the value of this limited partner interest is not likely to change significantly over the course of 2 days. Taxpayers go out, they get their appraisal, they go ahead and report the gift on the gift tax return as not being taxable, because if you remember back in 2008, you had a $2 million exclusion amount. This particular trust had 8 different crummy powers that were added in, which meant that the first $96,000 or $12,000 per beneficiary was eligible for the gift tax annual exclusion. So in other words, they were transferring the maximum amount possible by gift, following that up then by a subsequent sale for roughly 10 times the dollar amount later. Pretty straight over tackle installment sale technique. But look at the problem in the formula clause that they use. Rather than saying, I'm going to give $2 million worth as finally determined for gift tax purposes, it says, I'm going to give $2 million as determined by an appraisal. Well, when they go get the appraisal and they use that appraisal to determine how much of a limited partner interest translates to $2,096,000, notice that that language commits them to using the language in that appraisal. The IRS convinces the tax court that they're bound by whatever their appraisal says. So if we can show that the appraisal was overly aggressive, they can't come back and say, oh, well, then therefore we'll make a smaller gift because we're only giving $2 million worth. No, your document says you're giving $2 million according to that appraisal. So they used the wrong language, unfortunately, in creating that formula. So guess what? They made a taxable gift in 2008 and they made a taxable gift in 2009. Because in both cases, relying on the overly aggressive appraisal ended up resulting in a taxable gift. If the Nelsons had a do-over here, they do one of two things. They would either use the same language that you see in the Wandry case that says, I'm going to give $2 million as finally determined for gift tax purposes. Or alternatively, what you could do is you're going to say, I'm going to give the lesser of $2 million as determined by an appraisal, or my remaining federal gift tax basic exclusion amount. That way you're making it clear that, okay, yeah, I'm going to use the appraisal to determine how much is being transferred, but in no event am I giving an amount in excess of my remaining basic exclusion amount. Had they done it that way, their formula clause probably would have worked. So the Nelson case is a reminder, you got to do formula clauses. It's just a reminder of you got to do it correctly. The Nelson case should not deter you from using a formula clause. It should be your lesson of just make sure you have the correct language in your formula and you should be good and set to go. Okay, Next technique that we want to talk about is this idea of creating the non-grantor trust to be able to save on state income tax. Before we talk about this particular strategy in detail, Taryn, I'm wondering if you could throw up the second poll question here, because I'm interested how many of the participants watching this have actually seen their clients implement one of these so-called incomplete gift non-grantor trusts. So the simple question that's being asked in here, have you ever had a client that has used a trust just for the purpose of saving on state income tax, doing this incomplete gift non-grantor trust strategy? And we'll give you a few minutes. The kernels are popping unbelievably right now. And when it starts to trail off, we'll track and see how it's looking here on this. And there's a clear emergent majority answer happening in here so far, but no spoilers from me, folks. We're just going to have to see how it plays out. There's still a couple of people trickling in with some responses. Give them just a couple of more seconds to be able to chime in on whether folks are doing this. And just as a reminder, while we're waiting on things, if you're coming up with questions over the course of the chat or of the webinar here, feel free to put them into the chat. Kate's going to be monitoring them, and when we get to the Q&A section here at the top of the hour, she'll pose whatever questions look to be best in there. So, all right, here we go. We're going to share the results here so that everybody's able to take a look at them. As you can see, overwhelmingly, no, you haven't had clients that have done this, but check it out. 30% of the audience has had at least one client that has done this, and that's a fairly significant amount when you think about it. And notice that we even have a fair number that are indicating, more than just a couple have done this. And I think that that's quite smart, because this is a pretty good technique. And if you don't have clients that are doing it, I get it and I can understand, and we'll talk about why that might be the case. But it is certainly something that I think that you'll want to have clients at least aware of as a possibility. So let's talk about this. You already had case law. You already have the McNeil case there in Pennsylvania ever since 2013 that has told you, for the most part, yeah, this strategy works, even though nominally you have a state statute that says you can tax a non-grantor trust solely on the basis of having had a Pennsylvania grantor. That can make a trust subject to Pennsylvania state income tax. The McNeil case that you have in Pennsylvania says, yeah, but if that's the only connection that the state has with the trust, that's not enough to be able to satisfy the US Constitution's due process clause. We'll now fold that in with the Supreme Court decision in the North Carolina Department of Revenue versus Kimberly Rice Kaestner 1992 family trust case. Remember, in that case, you had a New York grantor that had created an irrevocable non-grantor trust for the benefit of his 3 kids. That particular trust, although it had a New York grantor, had a Connecticut-based trustee, and all of the assets in this trust were investment accounts that were housed in a Massachusetts bank. So you had really no connection at all with the state of North Carolina, save for the fact that the discretionary beneficiary of this trust was a resident of North Carolina. The original trust was created for the grantor's 3 kids, but right away, the trustee divided it up into 3 separate trusts, one for each kid, which you and I, having been in this field a while, we say, yeah, that makes sense. It always blows a client away, right? The client always thinks, well, if I leave Blackacre to the 3 kids, that will bring them to the table together, force them to work through their differences, and they'll learn how to co-own assets together. Whereas you and I know that before the body is even cold, the kids have already filed a partition action seeking to divide Blackacre into 3 separate parcels so that they can either manage their own separate parcel or just cash in and go their own separate way, right? That's just what kids do. Well, it turns out that Kimberly's trust, the terms of Kimberly's trust say that until she reaches age 40, the trustee can make discretionary distributions for her maintenance, education, support, and health. When she turns 40, if she's still alive, she gets everything. If she dies before reaching age 40, she can execute a will under which she leaves the trust to whomever it is that she chooses. So look, this thing is Kimberly's trust. She is the only permissible appointee until age 40. When she's 40, she's the only one who gets the assets. If she dies before then, she's the only one who gets to decide what happens to those trust assets. So they are there for her. North Carolina said, okay, although during the taxable years at issue here in this case, which was what, 2008, 9, 10, and 11, although there were no distributions in fact made to Kimberly, because Kimberly was a discretionary appointee of trust distributions, that's enough to give us jurisdiction to tax. And in a deeply divided 9-0 decision, the US Supreme Court decides, nope, that's not enough of a connection to satisfy the due process clause as a matter of federal constitutional law. So in effect, the Kaestner case says, well, wait a minute, if I can structure a trust so that I might have a Pennsylvania beneficiary who's just a discretionary Pennsylvania beneficiary, couple that with the McNeil case that says if the only other connection that I have with the trust is that I have a Pennsylvania grantor, but that Pennsylvania grantor has retained no powers of administration and no rights to distribution, this might be a way in which I can defer some state income tax. So how does this particular strategy work out? Well, the idea is I'm going to create a trust that is not a grantor trust for tax purposes. Instead, it is structured as a non-grantor trust. I might, for convenience, situs it in Delaware, because then I just have to step across the state line and I'm there. But Nevada would like you to remember that Delaware was not the first state to create prostitution. So you could do this same process in Nevada as well. And South Dakota would like to remind you that there's more to the state than just a hill with 4 heads on it. So you're welcome to do this there too. And Alaska would like to tell you why not park your assets there, because then they can see Russia from their house. So there's a number of states in which you could do this, but Delaware is going to be the most convenient for most of your clients. If I create a Delaware trust with a Delaware trustee and put all the investment assets into that Delaware bank account, although Delaware has an income tax, they don't tax trust income on a Delaware situs trust. So I'm good to go. Put in a spendthrift clause so that if I'm going to have a Pennsylvania beneficiary, that Pennsylvania beneficiary's right to potentially receive distributions won't be something that gives creditors backdoor access to those trust assets, and importantly, doesn't create enough of a connection between Pennsylvania and the estate. And make sure that my Pennsylvania beneficiary has no vote or participation in trustee selection or removal or in replacement. In other words, I'm going to try to repeat as much of what Kimberly Rice Kaestner's trust was like in creating something for my Pennsylvania beneficiary. Well, then I'm good to go. If I transfer those assets as an incomplete gift, then the nice thing is it is not a taxable gift for me to fund that trust. Because the trust is a separate taxable entity, it means that the trust is going to pay federal income tax. And yeah, that means that we're going to be in the 23.8% bracket with just over $13,000 of taxable income. But the whole idea is that you're saving on that, 3.7 or whatever small percentage of state income tax that would otherwise apply. So if the client was already going to be in the 23.8% bracket, you're not going to pay any more in federal tax, and you're saving on the imposition of that extra 3.7% in state income tax. You don't pay any state income tax unless and until a distribution gets made to an in-state beneficiary. This doesn't work in every jurisdiction. Some jurisdictions have these recapture mechanisms by which once there's a distribution, we tax them not only on that current distribution, but on all of the accumulated income. California has found a way around it. New York has found a way around it. But so far, and I should emphasize, I'm not licensed in Pennsylvania, so this was just based upon the research that I was able to do in preparation for this talk. But it looks to me like you have pretty favorable state law that would suggest this would work. And you saw from the earlier poll of your colleagues, 30% of your colleagues have a client who's at least done this. So in the right situations for the clients that are looking to be able to save on state income tax, the combination of your McNeil case plus the Supreme Court's decision in Kaestner suggests this is still something that your clients should be looking at, especially if you think there's a chance that state income tax could be going up. Okay, Oh, by the way, one other little benefit, PowerPoint's reminding me here, for any assets that are left inside that trust, because I never made it complete a gift, even though it's not a trust that's part of me for income tax purposes, those assets still get a step up in basis when the grantor dies. So it's like you still owned the assets for transfer tax purposes. It just, you didn't own them for state income tax purposes. It's kind of the best of both worlds. It works out really well. All right, next technique that we want to just talk about very briefly, that's the idea of using charitable remainder trusts as the beneficiaries for retirement plans. This idea has been getting a lot more popular as a result of the Secure Act that we had at the end of, what was it, 2018, so pre-pandemic, so 2000 and late. Doesn't it feel like it was 15 years ago that we were talking about the Secure Act? We know a lot of the highlights of the Secure Act, with delaying the implementation of required minimum distributions and getting rid of the age cap for contributions to traditional IRAs, and for substituting the what happens when subsequent beneficiaries take the place of an existing named beneficiary. But we all remember that the big estate planning impact, SISM, from the Secure Act was getting rid of the ability to be able to do a lifetime stretch out when the beneficiary is someone other than a surviving spouse or a minor child or a disabled or chronically ill beneficiary, or anybody who is more than 10 years younger than you. So I can still do a lifetime stretch out if I name my spouse as the beneficiary of my IRA, regardless of how much younger my spouse is than me. I can still do this if I have the disabled or chronically ill beneficiary. If I'm naming a sibling as the beneficiary of my IRA or my pension plan, as long as that sibling is not more than 10 years younger than me, I'm good to go. But gone are the days when I could name my adult child or children as the beneficiaries of my retirement plan and get that lifetime stretch out for the many more decades that they were going to live. I'm condensed to now just a 10-year window in which I have to make all of the distributions. In steps then the charitable remainder trust. If I can name the remainder trust as the beneficiary of that IRA qualified plan, I can have that remainder trust paying an annuity or unit trust interest to my adult child for the rest of the child's life. Because remember, you could do a charitable remainder trust that lasts for the life of the lead beneficiary, with the remainder then payable to the charitable organization. So before, my child was getting a lifetime stretch out. Here, my child is getting a lifetime stretch out in the form of receiving an annuity or unit trust distribution from a charitable remainder trust instead. Now, because I'm using a CRT, the IRA and retirement plan rules say that the trust actually only has 5 years in which to withdraw the account balance down to zero. But remember, the trust itself is a tax-exempt entity. All of the tax that has been built up on those amounts inside of the account will be deferred and stretched out over the lifetime of the beneficiary. So in effect, do you see how the charitable remainder trust emulates a lifetime stretch out? The nice thing that you get in addition to it is, to the extent that there are still any amounts left inside of that account at the death of the child, instead of those amounts just simply going poof, they can go to the charitable organization, thus consistent with your client's philanthropic agenda, and managed well. That can then provide the lifetime support for the adult child, which is what you wanted in the first place, and a nice sizable bequest that can be down the pipeline for the organization that means a lot to you. So it's a really nice technique that a lot of people have been using to try to simulate what they had had before with a lifetime stretch out that's no longer available now. Okay, next up on the agenda, we want to talk about some other ways that we can get a nice little step up in basis. If you had a client who had created a grantor trust during life because they did the installment sale strategy, or because they've done other leveraged wealth transfers to that trust, very often one of the techniques to create grantor trust status is to give the grantor a power to reacquire trust property by substituting assets of equivalent value. We come to call it the swap power. I really love swap powers because they give you such a great opportunity to be able to get a step up in basis near death. Suppose you meet with a client, and when you meet with the client, you notice that the client's breathing is labored. and you make the determination that the client does not have long on this mortal coil before shuffling off. So very quickly, you do a little inventory and you say, wow, I'm so glad we created that grantor trust a long time ago because now it has millions in it. None of it's going to be subject to estate tax. Yeah, but the problem is, remember, the assets inside of that irrevocable trust are not going to get a step up in basis for tax purposes. But meanwhile, what does your client own apart from the trust? Well, the client's got $2 million worth of cash. Well, okay, good news, I guess. The client's going to get a step up in all that cash when the client dies. But cash already has a face value basis. So what's the point of dying holding cash? I mean, think about it, folks. Why do people cry at funerals? They cry because they're reflecting the lost opportunity for a full step up in basis. I mean, they'll use little euphemisms for it like, oh, he was gone too soon, or he was called home early. That's code for we didn't get an opportunity to be able to fully leverage the Section 1014 step up in basis. So here's what I do. If I got a client who's got $2 million of cash under the mattress, well, knock, knock, that's why you've got apnea. That creates a lump in the mattress. If I've got the client who's got $2 million worth of cash, take that $2 million of cash, swap it into the grantor trust, and pull out $2 million worth of low basis assets. When you transact with a grantor trust, remember revenue ruling 8513, that's not a taxable event. So there's no income tax consequence to that. There's no gift tax consequence to that. There's no added estate tax consequence because if before the transaction, the client would have $2 million of cash in the gross estate. After the transaction, we have $2 million of low basis asset. The only thing that happens is that low basis asset gets a step up in basis, and the cash sitting inside that trust, nothing happens to the basis of it anyway, right? You go to that person's funeral, they call it a celebration of life. Right? They talk about the legacy that the client, like, she really cared. She did a lot in her life. That's code for cha-ching, baby. We got a full step up in basis here. So let your client have a celebration of life rather than a mourned loss. By exercising that swap power, you can get those step up in basis right there with the assets that the client holds. Don't let your client die holding cash. That should be swapped into the trust and let the low basis assets come out and get the step up instead. Similarly, if you have a beneficiary like a surviving spouse, for example, and you say, boy, I wish that credit shelter trust or that exemption trust or that bypass trust, wish those assets could get a step up in basis because it turns out that the surviving spouse doesn't have enough to have an estate tax issue. If you can have a decanting, if you can have a trust protector, if you can have a trust modification such that surviving spouse can be given a narrowly crafted general power of appointment exercisable at death, the idea is not that the spouse will exercise the power, just that the spouse dies holding the power. That's enough to be able to get us a step up in basis for income tax purposes. And so there you go. It can work out really well. You see a lot of publications that are talking about so-called upstream sales where I can either gift or sell property, not to a trust, but to a parent, with the idea being that I can then take from that parent when the parent dies. We know that if I make a gift to a parent who turns around and dies within a year, that we won't get a step up in basis for that because Section 1014E says that's gross. The E stands for ew. You're laundering assets through a dying parent, you're sick. But if I can sell assets to a dying parent, I'm smart. Or if I can launder assets through a parent who will live for a year and a day, because I have a power of attorney over their healthcare directive before I pull the plug, then I'm smart and I can get a step up in basis that way. So that can also work. If I'm working with married couples, using a Q-tip trust can be really nice because remember, any assets in a Q-tip trust get a step up in basis when the surviving spouse dies. I don't get a step up in basis for assets in a typical exemption trust, bypass trust, AB trust, but on the Q-tip share, that I do get a step up in basis because Section 2044 requires that those assets be included in the surviving spouse's gross estate. So I see a lot of people using Q-tip trusts today, not because they want a marital deduction to save on estate tax. They're using Q-tip trust because they want to make sure that there's a step up in basis, not just at the death of the first spouse, but also when the surviving spouse dies. And the Q-tip trust gives you that nice little benefit. Of course, another option you could consider would be situsing a trust in a community property state, because remember, if it's community property, both halves of community property get a step up in basis on the death of the first spouse. So if I want there to be a full step up in all of the asset on the death of the first spouse, having a trust in a community property state with some extra gymnastics can work. One of the other strategies that I want to talk about in this low interest rate environment before we go head on into the Q&A stuff for sure is to talk about the use of the so-called ultra long-term GRAT. It's become very fashionable to create these short-term 2-year GRATs, right? Where we pay back to the grantor a 40 or 50% annuity. All you're really doing there is trying to zero out the GRAT, leverage the Section 7520 rate that it's so low. What you're banking on is if you can get a rate of return in excess of the 7520 rate, you come out ahead. But the problem that everybody's worried about is that, this potential legislation is talking about how there might be a 10-year minimum GRAT, and I can't do short-term GRATs anymore. Okay, well, why not this? Why not do an ultra long-term GRAT? Create a zeroed out GRAT with a term where I know the client is not going to survive. At first, you're like, well, are you nuts? That means that there's going to be gross estate inclusion when the client dies. Well, yeah, but remember, the GRAT regulations contain this little formula that says the maximum amount includable in the grantor's gross estate if the grantor dies before the GRAT is terminated is an amount determined by this fraction. Take the annuity amount, divide it by the 7520 rate in effect at death. So either that number or however much is left in the trust, whichever is smaller, that's the amount that will be included. So what you're betting on with the ultra long-term GRAT is that if the 7520 rate at death will be higher than the 7520 rate today, when you create the trust, you're only going to have a percentage of the trust assets subject to estate tax. Here's a simple example to illustrate how that would work. Suppose that I today put $10 million. A man can dream. If I put $10 million into a 60-year GRAT, now, why didn't I choose 99 years? Well, just because the calculator that I have only goes up to a maximum of 60 years. I think after that, it says, what, are you nuts? You're going to create malpractice here. Don't do this. So it doesn't let me go above 60. So I said, all right, 60 years. I'm pretty confident I'll be dead in 60 years. If I do it today, when the 7520 rate is at 1%, then if I want to zero out a 60-year GRAT, I need to pay myself an annual annuity, as you see here, of just in excess of $222,000. Well, let's imagine that I die 20 years from now. It was a good run. I'm going to assume that the 7520 rate 20 years from now is the same as what it was 20 years ago. If we assume that interest rates are kind of cyclical, I don't think that's a horribly unreasonable assumption. If the 7520 rate when I die is at 6%, then what I include in my gross estate is $222,445 divided by 6%, which, as you see, translates to just over 3.7. So I have to include $3.7 million in my estate. That's the maximum amount that I have to include in my estate. But here's the thing. If my trustee of that GRAT can just grow that trust at a rate of 5%, even after paying me $222,000 and change every year for the 20 years that I'm alive, that trust is going to have over 19 million left inside of it. So by including only 3.7 out of 19.1, 19.2, I'm only subjecting 19% of the trust assets to estate tax. All of that additional amount, I'm not paying any transfer tax on at all. So yeah, I'm going to pay some estate tax, but the idea is I'm paying estate tax on very little. And in fact, if I can grow it at more than 5%, I can really come out ahead. And if the 7520 rate happens to be even higher than 6%, this just works even that much better. But you got to be doing this sooner rather than later, because already we know next month the 7520 rate is 1.2%. The direction is trending upwards. So get on this bandwagon if you want to do this math experiment sooner rather than later. Last technique that we're going to talk about before we do a little bit of Q&A here at the end and send you off, hopefully happy and healthy off to lunch. We need to talk a little bit about slats. Before we do so, Taryn, let's throw up our last of our poll questions for your accreditation purposes in here. I want to know whether you've had any married couples that have created a spousal lifetime access trust or SLAT. Please indicate if you've had a client who's done one yet, or if you've had maybe just a couple or a few or several, or in fact, most that have done this SLAT strategy. We'll talk about why they would be interested potentially in doing this in a second, but we just want to get a sense of how many of you have had clients who've actually done this at this point. Just a reminder, if you have any questions, you can throw them into the chat function, and time permitting, we'll get to a few of them as we can, but we do want to make sure that we at least talk about this last little technique before we turn it over to that. I think it looks like our numbers have kind of stopped coming in, so we'll go ahead and share the results on here. And as you can see, majority have not had anybody do it, but a fairly sizable number in there, just eyeballing it. 47% have indicated they've had at least one couple that have done this. So this has become an increasingly common and pretty powerful technique. Part of the reason why slats end up working, of course, is because we had those recently finalized anti-clawback regulations that say the basic exclusion amount is either what is the exclusion amount at death or how much did you utilize during life. So the clawback regulations make it clear that if you use the 11.7 now before it goes down, you won't be looking at paying any extra estate tax on the amount by which your $11.7 million gift exceeds whatever is the exclusion amount at the time of your death. So with that in mind, the thinking behind the slat is, okay, let's have one spouse create an irrevocable trust for the benefit of the other spouse. When you're pitching it to a client, you may not want to call that person the BS, but whatever. It is structured just like a credit shelter trust, exemption trust, bypass trust, except it doesn't require the first spouse to die. The nice thing, we make sure that it does not qualify for the marital deduction because we want to use up the donor spouse's exclusion on this. You can structure it as a grantor trust for income tax purposes, though, so that it's not being treated as a separate taxable entity, and you can still continue to pay tax at normal rates. The nice thing is when the beneficiary spouse dies, there is no estate tax on all of the appreciation that has happened between now and the time that the beneficiary spouse dies. And to make sure that the kids or the stepkids continue to be nice to that beneficiary spouse, we can still give that beneficiary spouse a testamentary limited power of appointment to pick among the kids so that they all still have an incentive to remember that spouse's birthday and maybe a holiday present, whether it's at Christmas or Hanukkah or Kwanzaa or Festivus or whatever the occasion might be, to still honor and treat that surviving parent or that beneficiary parent nicely. Think of it as the lifetime credit shelter trust. That's the spousal lifetime access trust. If you think the exclusion amount is going down and you want a way to keep the wealth within the couple while still utilizing the exclusion, this seems to be the safest technique to be able to use. And there's enough other lemmings that have been doing it that you should feel pretty safe about that particular approach. All right, that's going to end the scheduled remarks that we have here at this point. Kate, if you want to come back on and power things up so that people can get a better view than what they've been enduring here for most of the last hour. Do we have any questions in the chat that we can answer?
We do. There surprisingly was a few about the McRib and when it's going to be back, but I'm going to skip over those. The first one here is,
October.
what is your take on the new 590B page 11-12 example?
Not a thing. Don't worry about it. IRS has already indicated that that was a mistake. They've indicated informally that that was a mistake and that they're going to get it fixed. It's referring to we thought that when there was a 10-year rule that we had 10 years to withdraw the amount, not that you had to withdraw an aliquot share over that 10-year period. Aliquot was my word of the day on my vocabulary calendar. It turns out that, and then there was this example that gets published in guidance in guidance from the IRS that says, no, in fact, you do have to take it out pro rata. No. That was a mistake. We all kind of knew that that was a mistake, or I guess more accurately, we were pretty sure that that was a mistake, and we're kind of worried now that this was maybe some backdoor repositioning on the part of the service. But again, informally, the IRS has indicated that that was wrong, that they're going to fix it, and hopefully we can all say that was much ado about nothing.
Okay. Well, it looks like that's actually the only question that came through. There were a couple of comments, but at this time, I want to thank you, Sam. That was a fantastic presentation. Really appreciate it. I do want to just remind everyone, Taryn, I know you're going to be posting the link for the survey in the chat, and then also the secret passcode that you need for your credits. Please make sure that you are completing that as soon as possible so we can get those credits to you. And also, we are going to follow up with you. There's been some questions about whether the presentation will be shared. Yes, we will share the slides and the recordings with you. If you have any issues at all with anything, please reach out to me personally. I can assist. And again, want to thank Estate Planning Council of Pittsburgh. Thank you for your sponsorship, as well as FNB Wealth Management, and of course, Sam Donaldson, who is just wonderful today. We appreciate you being here. And thanks everyone for coming.
Thank you. Do I get to fill out one of the evaluations?
Of course.
Oh, good. There'll be at least one good one in there. That works.
All righty. And we will leave that information up in the chat, of course, for you. So thank you. Have a great lunch.